Thanks for moving things around. It seems a bit more efficient.
Great, thank you, Deborah. Good afternoon, everybody. I'd like to call this meeting of the FDIC Board to order. We need a sunshine motion. Would someone like to make a sunshine motion? Thank you. In a second?
Second.
Thank you. I will all those in favor, please say aye.
Aye.
All those opposed? The motion is adopted. Thank you very much. We have several items on the summary agenda. Are there any questions or comments on the summary agenda? If none, I may have a motion to approve the summary agenda.
So moved.
Thank you. And a second?
Second.
Thank you. All those in favor of the summary agenda, please say aye.
Aye.
Opposed? The motion is adopted. We have two items on the discussion agenda today. The first is a memorandum and resolution relating to the proposed 2024 FDIC operating budget. Brett Edwards, Donna Saulnier, and Tom Petticord will present the case. Brett?
Okay, good afternoon, Chairman Grunberg and members of the board. We're here today to present for your consideration the 2024 budget and staffing authorization proposals. Specifically, we're requesting approval of an overall budget of $2.96 billion and authorized staffing of 6,817 full-time equivalent employees. So I will turn the floor over to Tom Petticord, who's our Deputy Director for Planning and Resource Management, and he will take us through the details of our proposal, and after that, we'll be happy to answer any questions you may have. Tom?
Thank you, Brett. Mr. Chairman, members of the board, I'm pleased to be here to present to you the proposed 2024 FDIC operating budget. This budget is the culmination of about a 5-month process that started back in July with the senior leadership team beginning this process, sort of diagrammed up on the screen, taking a survey of the industry, looking at the profile of FDIC insured and supervised institutions, and basically trying to develop a workload basis to underpin the budget. So let me move forward and just give you a quick overview. As noted on the screen, the budget is actually down 6.3% from 2023, but that masks movement in different directions in the two major components of the budget. The receivership funding portion of the budget component, is down more than half to $350 million from $825 million this year, largely because we have completed much of the work associated with the failures of the 3 large regional banks earlier this year. We had, as you remember, we had to increase the budget back in May substantially to address the costs that were associated with those failures. The ongoing operations budget component, on the other hand, increases by about 12% from 2023, or it's up about $275 million. The proposed staffing for the corporation would remain relatively constant. It would go up by 189 positions to 6,817, and that is a mix now of both permanent and non-permanent positions. You may remember that when we have temporary workload, as we have associated with the aftermath of the 3 failures, we always try to keep those resources non-permanent so that it would be easier to return to the permanent base without any disruptive downsizing. The ongoing operations budget increase is primarily attributable to 2 factors. The single most important factor is the terms of the compensation agreement that we adopted last year. It provided for substantial increases for FDIC employees in both merit increases and some benefits. I think this is common across our agencies, and it accounts for about $100 million of the $217 million increase in salaries and compensation, a little bit more than $100 million. The other big component of the increase, or big factor behind the increase, is the increase in staffing, and it's not just the 189 positions that are reflected in this budget proposal, but in the middle of this year, we added substantial resources as a result of the failures. And so we have to pay the full year cost of those positions as well as the full year cost of the new positions. For example, we added 126 non-permanent positions in the middle of the year in the Division of Resolutions and Receiverships to provide the resources necessary to deal with the management of the receiverships that resulted from those failures. The proposed budget and staffing increases proposed here are largely attributable to the lessons learned from those 3 regional bank failures. New positions are proposed in both supervision and in the resolution area to address areas that we identified as needing more resources as a result of our direct experience from that failure. So part of it is the staffing increases. There's another $30 million in employee pay increases, proposed employee pay increases and incentives that are related to the lessons we learned looking back at the 3 failures. So for example, the Chief Risk Officer performed a review of the failure of Signature Bank and identified a number of recommendations, number of areas for consideration. And these incentives and increases are very much targeted to the issues raised in that review. There's about $30 million. Some of these will be subject to negotiation with NTEU, and we will, of course, satisfy all of our bargaining obligations there. And finally, a substantial increase is proposed in DRR's permanent staffing platform. I mentioned that we added non-permanent staff in the middle of the year. As we went through the fall and we looked at the experiences we had gone through in the spring, our management and DRR concluded that we really needed to beef up the permanent staffing platform so that we had preparedness to deal with more problems in larger banks. Banks are getting larger. Until recently, we've not had to deal with very many large failures or medium-sized failures. This will give us the capacity to be ready to handle those kinds of institution failures in the future. Let me talk a little bit about the economic and workload projections that we made at the beginning of this process. Although the banking industry has remained relatively resilient, there are a number of risks that were identified by our senior leadership that needed heightened attention as we move into 2024. High interest rates and inflation continue to create some uncertainty, as does geopolitical factors. The kinds of problems that emerged with the failures of the 3 banks earlier this year, unrealized losses on securities, longer asset maturities, declining deposits could potentially create more situations where we have liquidity issues. And finally, we have begun perhaps to see the beginnings of this, but our expectation is that we will see continuing over the coming year a gradual deterioration in the commercial real estate portfolios of some of our insured institutions. The result of all of that is that we project that there will be an increase next year in the number of problem banks, those that are rated 4 and 5 on CAMEL's ratings. The numbers will still remain low by historical standards, but materially increase from where they are today. As has been true for a lot of years, the number of supervised and insured banks continues to decline through institutional consolidation, but banks are getting bigger and arguably more complex as that consolidation occurs. We do project that there will not be any unusual increase in community bank level failures. And we have projected that we have based our budget on no failures of medium or large-sized banks. Caution, of course, is we didn't predict that last year either. So our predictions are sometimes wrong. We do, however, anticipate that there will be banks where we will have resolution staff looking at the banks potentially because they've been identified as problem larger banks. And most of our active receiverships today are an overhang from failures during the crisis. We have been working down the number of receiverships and the associated workload for a decade, and they will continue, that work will continue to decline in 2024. You can see the number of receiverships declining by about a third, and the number of assets continuing to decline. You look at where our proposed staffing increases are focused, you'll see that they're primarily in the supervision and resolution-related lines of business. Additional RMS positions are proposed primarily to bolster large bank supervision. So we have proposed in this budget new positions to implement enhanced offsite monitoring procedures that were put in place following the failures in the early part of the year. And so we've added case managers, for example, in the regions to be able to provide the necessary resources to be able to do that enhanced monitoring. There are more positions for dealing with emerging technologies and with those kinds of issues as well. Additional staffing is also proposed for the dedicated exam teams that are assigned to the largest FDIC supervised banks. And the result of that is that there's a small increase in large bank examination staffing, more than offset actually by a reduction in projected community bank examination staffing. That declines by 23 positions in this budget. So authorized staffing overall in RMS will increase by 128 positions from where it was when the board approved the budget a year ago. It combines both mid-year increases this year and increases in this budget. I mentioned that DOR's done an analysis that indicates they need more permanent staff. We currently have 355 authorized positions, permanent positions in DOR. That would increase by 20% or 71 positions. Finally, a net increase of 25 positions is proposed in DCP. The largest number of those positions will be an addition of 10 dedicated examiner positions to the complex bank program that you approved establishment of that program last year in the budget. New headquarters positions are also proposed to focus on deposit insurance misrepresentation, technology and emerging issues around the use of artificial intelligence by supervised institutions, and to deal with the more complex enforcement cases that we currently have. Funding is also proposed in this budget for two multi-year initiatives that have been underway for several years. The IT modernization program in the current budget is funded at about $70 million. You can see it's proposed next year at $79 million. And what's happening is I think we are moving increasingly past the planning for these major modernization projects and getting into the operational parts of these projects, and the costs are increasing. I would expect that will continue, not just next year, but in the years beyond. And $73 million is included for a facilities modernization effort. It's a little bit different than IT modernization. I think we may move past the bulk of this in 2024. We've got 56 field office modernization projects planned. About 2/3 of those are already underway, and so we'll be finishing them next year, and then we will be finishing the remaining offices. We have 80 field offices, so you can see 56 is the great bulk of those. There's also a planned expansion of the Atlanta and Dallas regional offices to accommodate our return to office plans next July. All right, the rest of this is charts and graphs. So you can see on this budget what I described at the beginning. The red portion of each bar is the receivership funding piece. You can see that that shrinks substantially from 2023 to 2024, while the blue part, the ongoing operations component of the budget, increases. This gives you a multi-year look at how that has gone, how that has varied from year to year. We expand and contract receivership funding as failures occur, and very much illustrates that here. You get a look at the ongoing operations, which is the more like the continuing costs that we always have to fund year by year, and you can see that after being relatively flat for most of the teens, it began to rise in 2019, and it has continued to rise a little bit each year thereafter. Authorized staffing, you can see the difference in the red and the blue here between permanent and non-permanent. We have an additional set of non-permanent positions proposed, and then the additional positions that I discussed earlier in the blue. You can see the staffing trend over time. One thing that is notable is that there's a significant gap between onboard and authorized numbers that began to emerge following the pandemic, and we've been struggling with filling our positions there, but we are hoping to close that gap going forward. This gives you a view of the budget by the major components. It kind of illustrates the differences in our approaches to these two different sets of work. The ongoing operations are primarily salaries and benefits. A little bit more than 2/3 of the budget is devoted to that single expense category. On the receivership funding side, of course, we try to keep things more temporary or easier to expand and contract resources, and so it's primarily funded by outside services or contractual services. We try to give you a sense of how this breaks down among our three major program areas. Supervision always constitutes more than half of the budget. It's the significant driver within our budget. But when you look at the total operating budget, you can see the impact of the failures this year as, for the first time in a while, that portion of the chart actually is less than 50% a little bit. So that's a quick overview of the budget. In summary, we are recommending that the board approve the budget in front of you for $2.962 billion and an authorized staffing level of 6,817. And we'd be happy to take your questions.
Tom, thank you. That was very helpful. I have a brief statement, and then I'll turn to the other members of the board. The FDIC Board is considering today a proposed 2024 FDIC operating budget of $2.96 billion. The total proposed budget reflects a reduction of 6.3% from the total 2023 FDIC operating budget. The receivership funding component of the proposed budget is funded at $350 million. That's a reduction of 57.5% from this year's $825 million receivership funding budget due to the completion of much of the post-failure workload associated with the three large regional bank failures that occurred earlier this year. The ongoing operations component of the proposed budget is funded at just over $2.56 billion. That's an increase of $275 million, or 12% from 2023. This proposed budget was formulated following this year's three large regional bank failures and reflects the lessons learned from those failures. Although the FDIC successfully fulfilled its core mission responsibilities of maintaining financial stability and protecting insured depositors in resolving those bank failures, the resources of the FDIC were strained during that period, and we identified several areas where we needed to strengthen our existing capabilities on a long-term basis. This proposed budget directly addresses those needs. Of particular importance, the proposed budget includes substantial new resources, building on resources added earlier this year in the immediate aftermath of the three bank failures, to increase staffing, to perform expanded supervisory monitoring of large insured institutions on an ongoing basis, to support early detection of emerging risks, and quicker action to ensure that banks are taking the necessary steps to mitigate such risks. That includes resources to address recommendations made by our Chief Risk Officer in reviews of FDIC supervision of the institutions that failed. New staffing resources are also provided to ensure that the FDIC is prepared to act quickly and effectively to resolve the failure of another large regional bank, if that were to become necessary. Further, the proposed budget provides additional resources to address the potential risks to depositors and consumers of emerging technologies that are beginning to be used by banks, such as the use of artificial intelligence in credit underwriting models. Additionally, we are adding dedicated examination staff to enhance our oversight of complex institutions that are offering products that pose the greatest potential risk of consumer harm, including those offered through third parties. We will also continue our efforts to educate the public about what products FDIC insurance covers and does not cover, and to take decisive action to address misleading representations about whether funds invested in some of those products are, in fact, insured. The proposed budget includes substantial funding to continue our multi-year IT modernization program and our multi-year facilities modernization effort. Both of these initiatives are critical to ensuring that the FDIC's future workforce will have the tools and resources needed to continue fulfilling our important mission. I would like to thank all the members of the FDIC board for their constructive contributions, and the Vice Chairman in particular for his helpful suggestions in finalizing the proposed budget. I would also like to express my appreciation to all of the FDIC employees who played a role in putting the proposed budget together. Their contributions and hard work have presented us with a responsible and forward-looking budget and staffing proposal for 2024 that I am very pleased to support. That concludes my statement, and I'll turn to Vice Chairman Hill.
I'm going to vote in favor of the budget. I don't have a statement, but I do just want to thank the staff for all the work that went into the budget, and express my appreciation to the staff and to the chairman for the flexibility and willingness to engage on issues that were raised. Thank you.
Thank you. Director McKiernan? Director Sue? Director Chopra?
Tom, thanks for all the work you put into this. Let me just make one or two comments, which is that my back of the envelope of your tables and charts really suggests that a good amount of the increased expenditure categories going forward, but also in recent history, are really related to the largest and more complex institutions. So we should really take that to heart, that not only are they costing more, I think, even proportionally, but also those are the ones that have the greatest risk to losses to the fund. So I will just reiterate, I think we need to constantly think about our deposit insurance premium framework, and are the smallest subsidizing the largest, and we should really be thinking about that. But thanks, Tom.
If there are no further comments or questions from the board, may I have a motion with respect to the 2024 proposed FDIC budget? Thank you. And a second?
Second.
Thank you. I'll call the roll for the vote. I vote aye. Vice Chairman Hill,
Aye.
Director McKiernan,
Aye.
Director Sue,
Aye.
Director Chopra.
Aye.
The ayes have it, and the motion is adopted. Thank you all. Thank you very much. The second item on the agenda for today is a memorandum and resolution relating to the final rule on FDIC official signs and advertising requirements, false advertising, misrepresentation of insured status, and misuse of the FDIC's name or logo. Luke Brown, Ed Hoff, Chantal Hernandez, Miran Wanwozen, and Vivek Kare will present the case. Luke?
Good afternoon. Today, FDIC staff are presenting to the board recommendations for finalizing a proposal to amend Part 328 of the FDIC's regulations, which include rules governing insured depository institutions' use of the official FDIC sign and advertising statements, as well as rules relating to false advertising, misrepresentations regarding deposit insurance coverage, and misuse of the FDIC's name and logo. The FDIC board issued the proposed rule for public comment in December 2022, and in response to the proposal, the FDIC received 17 substantive comment letters. This rulemaking has two primary objectives that go to the core of the FDIC's mission of maintaining stability and public confidence in the nation's banking system. First, a final rule would modernize the current FDIC official sign and advertising rules to ensure they keep pace with significant changes that have taken place in the banking industry and that they reflect how consumers do business with banks today. Second, the final rule would clarify the FDIC's false advertising and misrepresentation rules to address misconduct in internet banking channels by persons, including non-bank entities, that are misusing the FDIC name or logo and inaccurately describing FDIC deposit insurance coverage. Importantly, both of these two objectives, modernizing the FDIC sign rule and clarifying the misrepresentation rule, would enable consumers to better understand when they are dealing with a bank and when their funds are protected by FDIC deposit insurance coverage. Since the 1930s, the black and gold FDIC official sign displayed next to bank branch teller windows has given bank customers confidence that their deposited funds are safe. The FDIC official sign and advertising rule at Part 328, Subpart A, governs such sign requirements for banks, but the rule was last substantially updated in 2006. Since then, there have been significant market and technology developments, and consumer banking habits have substantially changed. Bank customers increasingly rely on internet and mobile banking channels to access banking products and services. For many bank customers, banks' websites and mobile banking applications are used as their primary method of accessing banking products. As a result, these technology platforms functionally serve as today's digital teller windows for many bank customers. At the same time, the FDIC has observed an increase in misleading representations about deposit insurance by persons and non-bank entities on the internet. This development can serve to blur the distinction between banks and non-banks online, potentially creating confusion for some consumers. The final rule addresses this potential confusion in several ways. For example, to mitigate potential consumer confusion, the final rule would require that banks display across all their banking channels consumer disclosures, signs differentiating insured deposits and uninsured non-deposit products. 3 consumer disclosure signs these consumer disclosure signs would be displayed in bank branches and other physical premises, on bank websites, mobile applications, and automated teller machines. These requirements would align the FDIC's sign rules with market developments and consumer banking habits. Okay, with that, next, FDIC staff will summarize the final rule's primary provisions. Ed Hoff, Senior Policy Analyst in the FDIC's Division of Depositor and Consumer Protection, will begin by addressing sign requirements for bank branches and physical premises. Ed?
Great. Thank you, Luke. For bank branches and other physical premises, the final rule would include two distinct signs relating to deposit insurance. The first is the FDIC's official sign. As Luke noted, banks have displayed the gold and black FDIC official sign at their principal place of business and branches next to teller windows since the mid-1930s. The final rule would require all banks to continuously, clearly, and conspicuously display the official sign at places of business where consumers have access to or transact with deposits, including U.S. branches and other physical premises such as cafe-style locations, in which consumers have access to or transact with deposits. To accommodate evolving styles of bank branches and other premises, the final rule would provide separate requirements for traditional branches and other places of business, such as cafe-style locations. More specifically, under the final rule, there would be two main requirements related to displaying official signs at bank locations. First, at traditional branches, if banks usually and normally receive deposits at teller windows or stations, they would be generally required to display the official sign at each teller window or station. As a result, this is not a change for most banks. Specifically, for banks that currently display the official sign next to each teller window, they could continue to do so, and that would be consistent with the final rule. Notably, the final rule also provides banks flexibility in displaying the official sign. For example, if a bank branch accepts deposits at its teller window and only offers deposit products on the premises, then it can choose to display one or more official signs that are legible from the teller windows. Second, at other locations, such as cafe-style locations that may or may not include teller windows or stations, the final rule would include display of the official sign where deposits are usually and normally accepted. For example, at a cafe-style location that usually and normally accepts deposits in the middle of a cafe and not at a teller window, the final rule would require the bank to display the official sign in one or more locations large enough to be legible from the deposit-taking area. The second sign requirement in the final rule would mitigate the risk of consumer confusion when a bank offers both insured deposits and non-deposit products through the same banking channel, such as a bank branch. In that situation, a bank generally would be required to physically segregate the areas where non-deposit products are offered from areas where insured deposits are usually and normally accepted. In addition, the bank must display signs continuously, clearly, and conspicuously stating that the non-deposit products are not insured by the FDIC, are not deposits, and may lose value. Also, this sign should not be posted in close proximity to the official sign. Lastly, the final rule would provide banks with the flexibility to use electronic media to satisfy the sign requirements on a bank's premises. This provision applies to both display of the official sign and the non-deposit sign, where required, and would similarly be subject to the continuous, clear, and conspicuous display standard. For example, a bank could use a computer screen or similar electronic media to display the official sign in bank branches instead of using the physical sign. With that, I'll turn it over to Marone Monmosin, Chief Supervisory Policy in the FDIC's Division of Depositor and Consumer Protection, to cover sign requirements for banks' digital banking channels.
Thank you, Ed. With respect to bank websites and bank mobile applications or bank apps, the final rule would modernize the FDIC sign rules to treat a bank's website or app as a digital teller window. Under the current rules, banks are required to display the official FDIC sign near bank teller windows, but bank websites or mobile apps are not required to display an official FDIC sign, although bank customers conduct business through bank websites and apps in a similar manner as in a brick-and-mortar bank. When consumers log on to their bank website or download their bank's app, they are essentially in a digital bank branch or at an online teller station. The revisions in the final rule would extend the certainty and confidence associated with the FDIC official sign to digital channels. Under the final rule, banks would be required to display clearly, continuously, and conspicuously a newly established official FDIC digital sign on banks' websites, banks' homepages, landing and login pages or screens, and transactional pages or screens involving insured deposits. The official FDIC digital sign would prominently bear the name of the FDIC and state that insured deposits are backed by the full faith and credit of the United States government. The digital sign would promote a clear understanding by consumers of when they're interacting with a bank rather than with a non-bank. To be clear and conspicuous, the official FDIC digital sign must be displayed near the top of the screen or page in close proximity to the bank's name. With respect to banks' digital deposit-taking channels, such as websites and mobile apps that offer non-deposit products, the final rule would require banks to display a non-deposit sign indicating that non-deposit products are not insured by the FDIC, are not deposits, and may lose value. This non-deposit sign would be required to be displayed clearly, conspicuously, and continuously on each bank page relating to non-deposit products. Under the final rule, the non-deposit sign requirement would apply where banks' digital banking channels offer both deposit and non-deposit products, and it is intended to prevent consumer confusion. In addition to the requirement to display continuously a sign indicating that a product is not FDIC insured, is not a deposit, and may lose value, the final rule would also require banks to provide a one-time per session non-deposit sign notification when a bank customer leaves a bank's website to access non-deposit products from a non-bank third party's website. Specifically, the notification would only be required for bank customers who are logged into their bank's website. For example, if a bank customer clicks on a link to leave their bank's website to access a non-deposit product from a non-bank third party's website, the non-deposit notification would pop up, for instance, and the bank customer would need to take action to dismiss the notification before accessing the relevant page or screen on the non-bank third party's website. The notification would need to clearly and conspicuously indicate that the third-party non-deposit products are not insured by the FDIC, are not deposits, and may lose value. I will now turn the presentation back to Ed, who will discuss the final rule with respect to ATMs.
Thanks, Maron. So for ATMs, the final rule would contain the following three requirements. First, for an IDI's ATM or like device that receives deposits but does not offer access to non-deposit products, the final rule would provide flexibility to meet the signage requirement by either, one, displaying the FDIC official digital sign electronically on the ATM screen, or two, displaying the physical official sign on the ATM. Second, if an IDI's ATM accepts deposit and offers access to non-deposit products, the IDI would be required to display the digital official sign electronically on the ATM home screen and each transaction page relating to deposits. For the non-deposit products, the bank's ATM would be required to display electronic disclosures indicating the non-deposit products are not insured by the FDIC, are not deposits, and may lose value on each transaction page related to the non-deposit products. And third, for banks' deposit-taking ATMs or like devices that are put into service on January 1st, 2025 or later, the final rule would require display of the official digital sign. So if there are no questions, I'll turn it over to Vivek Khare, counsel with the FDIC's legal division, to cover policies and procedures.
Thanks, Ed. Banks have been increasingly entering into business relationships with non-bank third parties to provide banking products and other financial services to new customers and expand banks' access to deposits. In certain relationships, third parties make available bank products and services and offer those products and services directly to consumers. As part of the final rule, banks would be required to establish and maintain written policies and procedures for compliance with Part 328. Such policies and procedures must include, as appropriate, provisions related to monitoring and evaluating activities of third parties that provide deposit-related services to the bank or offer the bank's deposit-related products or services to other parties to ensure compliance with Part 328, Subpart B. Staff believes this new requirement is generally consistent with the interagency guidance on third-party relationships that was issued earlier this year. The interagency guidance underscores that a banking organization's use of third parties can increase its risk and that the use of third parties does not diminish or remove a banking organization's responsibility to perform all activities in a safe and sound manner and in compliance with applicable laws and regulations, including those related to consumer protection. In developing policies and procedures, banks should consider to the extent to which their third-party relationships involve representations or statements subject to Part 328 and the role third parties have in crafting or presenting such representations or statements for prospective depositors. The bank should also consider steps that it would take to mitigate misrepresentations related to deposit insurance that could cause potential consumer confusion and harm regarding a product provided by the bank. In addition, pursuant to the final rule, policies and procedures would be required to be commensurate with the nature, size, complexity, scope, and potential risks of deposit-taking activities of the bank. Having these policies and procedures in place will help mitigate the risks of consumer harm and confusion consistent with the statutory purpose underlying Section 18A of the FDI Act and the FDIC's mission to maintain and promote public confidence in the banking system. I'll now turn it over to Chantal Hernandez, a senior attorney with the Legal Division, to discuss the recommended clarifications to Part 328, Subpart B.
Thanks, Vivek. Part 328 also contains rules on misrepresentations regarding deposit insurance coverage, false advertising, and misuse of the FDIC's name or logo, which apply to any person, including non-bank entities. When entities misuse the FDIC name or logo or make misrepresentations about FDIC insurance coverage, there's a risk of consumer confusion as to whether the consumer is doing business with an FDIC-insured bank and whether their funds are protected by the FDIC. These types of misleading statements create uncertainty and could dilute and undermine the confidence that underpins bank stability and our nation's broader financial system. The amendments to Subpart B under consideration today aim to address these concerns by providing examples of specific statements and material omissions that constitute a misrepresentation, which will be helpful in providing clarity to consumers and industry. These examples would be part of a non-exhaustive list of conduct that violates Part 328, and the FDIC will continue to take action against any conduct that constitutes a prohibited misrepresentation about deposit insurance. Specifically, there are 4 scenarios that the final rule addresses. First, the official advertising statement and FDIC-associated terms and images have increasingly been used by non-banks that purport to deposit their customer funds at a bank. This presents a high risk of confusing consumers as to whether they are dealing with an FDIC-insured bank and whether their funds are FDIC-insured. To address this, the final rule would clarify circumstances under which use of the official advertising statement and FDIC terms and images by a non-bank constitute a misrepresentation of insured status. For example, a non-bank's use of either the official FDIC sign or the digital sign would be a misrepresentation if it inaccurately implies that the non-bank is insured by the FDIC and backed by the full faith and credit of the U.S. government. Second, staff has observed that non-banks that purport to deposit their customer funds at banks sometimes make statements regarding deposit insurance coverage for those funds. Absent additional context, such statements may suggest that the FDIC's deposit insurance will protect consumers in the event of the non-bank's insolvency. The final rule provides that if a non-bank makes statements regarding deposit insurance for its customers, it would be a material omission for the non-bank to fail to clearly and conspicuously disclose that it is not itself an FDIC-insured institution and that the FDIC's deposit insurance coverage only protects against the failure of an FDIC-insured depository institution. Third, staff's experience suggests that deposits and non-deposit products are increasingly being offered to consumers in ways that fail to distinguish which products are insured by the FDIC. The final rule would provide that if a person makes statements regarding deposit insurance in a context that involves both deposit and non-deposit products, it would generally be a material omission to fail to disclose that non-deposit products are not insured by the FDIC, are not deposits, and may lose value. Fourth, the FDIC has a long history of providing pass-through deposit insurance coverage, meaning that deposits placed at an FDIC-insured bank by a third party on behalf of one or more owners are insured as if deposited directly at the bank by the owner. It has become increasingly common for many non-banks to enter into an arrangement to deposit their customer funds at FDIC-insured banks, with non-banks often claiming to provide the protection of pass-through deposit insurance coverage for consumer funds. Such representations may mislead consumers and fail to apprise them of the risk they face in the event that pass-through requirements have not been satisfied. The final rule provides that if a person makes statements regarding pass-through deposit insurance for its customer funds, it would be a material omission to fail to clearly and conspicuously disclose that certain conditions must be satisfied for pass-through deposit insurance coverage to apply. I will now turn it back to Luke Brown for concluding remarks.
Thank you, Chantel. The amendments made by the final rule would take effect on January 1st, 2024, with an extended compliance date of January 1st, 2025. The extended compliance date is intended to provide sufficient time for banks and persons subject to Part 328's requirements to put in place processes and systems for implementing the final rules amendments. FDIC staff have carefully reviewed and considered public comments that we received in response to the proposal. Accordingly, staff recommends finalizing the rule primarily as proposed, with some changes and clarifications to address feedback from public commenters. We're happy to take any questions that you might have.
Thank you very much. This was clearly a team effort, so thanks to all of you for your very, very helpful presentations. I have a statement, and then I'll turn to the other members of the board. The FDIC board is considering today a final rule to amend the FDIC's regulations on use of the official FDIC sign and insured depository institutions' advertising statements. This final rule also clarifies the FDIC's regulations on false advertising, misrepresentation of insured status, and misuse of the FDIC's name or logo. This final rule modernizes FDIC signage requirements to reflect how depositors interact with banks today, taking into account, for example, digital banking channels. The way people bank has changed significantly, and banks are increasingly leveraging their digital channels, including websites and mobile applications, to offer products and services to their customers. The revisions in this rule extend the certainty and confidence that the FDIC official sign provides at bank branch teller windows to the digital channels through which depositors are increasingly handling their banking needs. The final rule considered by the board today also modernizes the rules governing the display of the FDIC official sign in branches and extends the application of sign requirements to other physical premises where consumers have access to or transact with deposits, such as, for example, cafe-style locations. The final rule establishes and requires a new digital version of the official FDIC sign. The final rule requires insured depository institutions to display this new FDIC official digital sign near the name of the bank on all bank websites and mobile applications. For many consumers, these channels may serve as the primary method of accessing banking products, acting essentially as a digital teller window. it's important to require a digital sign so that customers can confirm when they are interacting directly with a bank rather than with a non-bank entity, and to clarify when their funds are insured by the FDIC and when they're not. To that end, the final rule also requires banks to display disclosures differentiating non-deposit products from insured deposits, where both types of products are offered to consumers. This requirement is consistent with long-standing interagency guidance that many banks already follow and would help make clear when a consumer's money is or isn't insured by the FDIC. In addition, the final rule provides important clarification on false advertising, misrepresentation of insured status, and misuse of the FDIC's name or logo. The Federal Deposit Insurance Act prohibits any person from engaging in false advertising by misusing the name or logo of the FDIC or making knowing misrepresentations about the existence of or the extent or manner of deposit insurance. The FDIC has observed an increasing number of instances online where firms or individuals have misused the FDIC's name or logo or have made false or misleading representations about deposit insurance. For example, we have seen circumstances where certain non-bank entities were making unsubstantiated claims about deposit insurance. These practices can confuse consumers about whether they are dealing with an insured institution and if they are protected by deposit insurance. Combating misrepresentations about deposit insurance coverage goes to the heart of the FDIC's mission of maintaining stability and public confidence in the nation's banking system. These practices can not only confuse and harm those who are targeted with the false promise of deposit insurance, but if left unchecked, could undermine confidence in the FDIC, FDIC-insured banks, and the U.S. banking system. Today's final rule amends the regulations on misrepresentations regarding deposit insurance to expressly address several of these situations, making clear when certain statements or omissions constitute a misrepresentation under the statute. Finally, this final rule under consideration requires insured depository institutions to establish and maintain written policies and procedures to comply with the rule. Importantly, such policies and procedures would include, as appropriate, provisions related to monitoring and evaluating the activities of third parties that provide deposit-related services to the bank or offer the bank's deposit-related products or services to other parties. This would address an area of growing concern for the FDIC, where the relationship between a bank and a non-bank enables or gives credibility to certain misrepresentations of deposit insurance by non-banks. This final rule brings the certainty, safety, and confidence historically provided by the FDIC sign and FDIC insurance to today's varied banking channels, including digital banking. Earlier this fall, the FDIC launched its Know Your Risk, Protect Your Money public awareness campaign, which underscores how important it is for consumers to understand how deposit insurance works and how it protects their money. This rule complements that work by enabling consumers to better understand when they are doing business with a bank and when their funds are protected by deposit insurance. I would like to thank the FDIC staff for their outstanding work in bringing this final rulemaking to the board today, and I am very pleased to support this final rule. That concludes my statement. Vice Chairman Hill.
I'm going to vote in favor of the rule. While I don't agree with everything in it, I do want to thank the staff for the extensive engagement with me over the past few weeks. And I also would like to say that I appreciate the willingness of the chairman and the staff to compromise on a number of issues in the spirit of seeking consensus. This rulemaking effort began almost 4 years ago with the issuance of a request for information seeking input on how the FDIC could modernize its sign and advertising rule to reflect changes in how customers engage with banks, including in particular the increased use of online and mobile banking. I support the goals of promoting awareness of FDIC insurance, ensuring clear delineation between FDIC-insured deposits and uninsured non-deposit products, and providing additional clarity regarding the FDIC's expectations for non-banks that make representations or misrepresentations of deposit insurance. The final rule includes a number of important improvements from the proposed rule, including, among others, first, tailoring the ATM requirement by allowing existing ATMs that do not offer non-deposit products to display a physical FDIC sign rather than the new digital signs. Second, clarifying the FDIC's expectations for circumstances in which it is challenging to physically segregate the offering of deposit and non-deposit products at a physical location. Third, adding a number of important clarifications around disclosures for non-deposit products offered by non-banks that also offer pass-through FDIC insurance. And fourth, narrowing when a bank is required to show a pop-up or notification related to non-deposit products on the bank's website or app. The FDIC is also declining to include the proposed definition of crypto assets in the final rule, and further clarified that the final rule is not expressing a view on whether a financial product employing blockchain-related technology does today or could in the future fall within the statutory definition of a deposit under the FDI Act. While I agree that crypto assets generally are not deposits under the FDI Act and should be subject to the same FDIC disclosure regime as other non-deposit products, the question of whether and under what circumstances tokenized deposits, dollar tokens, and other similar products should be treated and reported as deposits is an important one for the FDIC and the broader financial system. The FDIC was working hard on this question, along with many related ones, in 2021 and early 2022, but it is unclear to me whether the agency has made any meaningful progress since then. Nonetheless, I agree that this rulemaking is not the appropriate vehicle for consideration of this issue, and I support the amendments in the final rule. Finally, I want to thank the staff for the multi-year effort to finalize the rule and look forward to voting in favor. Thank you.
Thank you. Director McKiernan? Director Sue?
I just wanted to say quick words, thank the staff for its excellent work on this, especially on Subpart B with regards to the non-banks. I think in this particular environment, with the rise of the volume and complexity of bank-non-bank partnerships, this is really, really important. And I think that the work that was done to highlight those examples is going to be very, very helpful, especially to clarify those obligations for non-banks. So I want to thank you for that.
Thank you. Director Chopra?
Just want to ask a couple questions for the record, and then we can talk through it a little bit. With respect to bank partnerships with non-banks, as the acting controller just referenced, could you just share a little bit more about how the policies and procedures section of the final rule interacts with the existing third-party risk management?
For still complying with the law and for safety and soundness, and in terms of applicable laws, it's also consumer protection laws that apply to them.
I want to talk just briefly about the disclosure of, quote, certain conditions apply. So I think if we look at the analysis and literature of all sorts of contract terms, disclosures, I think we should be very humble about the power of that statement, given what we see in digital commerce throughout our lives. There's often disclaimer language that is put on, which for many consumers is fairly meaningless. And so I hope we're just humble about the efficacy of this. And I will just share that it's very important that we recognize, and I acknowledge this, there's certain limitations of the FDIC's authorities here. So let me just ask a couple things on this. I think I asked this at the proposal stage as well. Obviously, this rule is a good step forward, but I just want to make sure we reiterate, is there anything in this rule that would displace the ability of a state consumer protection enforcer from exercising their own authorities, for example, to prohibit deceptive practices under state law?
No, there's nothing in the rule that should state or imply in any way that a state authority or federal authority cannot, state or federal action cannot be taken consistent with their authority.
Good. I think we should make sure it's clear that nothing in this rule is a safe harbor from any other statute that is exercised with respect to consumer protection at the federal or state level, and I'm glad we've done that. Luke, I just want to make sure the board knows, Luke has been a very, very outstanding collaborator with his colleagues at the CFPB, and we really consider this an issue that, with respect to non-banks, we will really have to all think together about this, as well as the various statutory contours that we have. So I wonder if you wanted to share a little bit with the board about how you're thinking about enforcement. We obviously did some cease and desist letters in the past, but it may be too early at this time, but any thoughts on how we might think about our strategy to deter non-compliance with this by non-banks?
Well, first of all, sort of back to the policies and procedures requirement, it's really important because there's a bank in these transactions generally that we're describing here. So you have the bank in the transaction. They're now required through this rule to focus on oversight and understanding what's being said by these third parties, including potential misrepresentations. So you'll have 5,000 banks, really targeted at understanding what's going on with respect to these relationships, which I think is very important. You saw in the budget a second ago that the FDIC has made the commitment to develop additional resources entirely focused on misrepresentations and violations of Part 328 so that we have the appropriate infrastructure in place to make sure that we're taking action. Our legal department has been extremely focused on enforcing the rule the last several years, and that's not to imply that they weren't previously. But as you say, there's been a number of CNDs that have been made public, so this is a really important priority for the FDIC going forward. So you'll see appropriate action taken, and that's from an enforcement as well as a supervision perspective.
Well, good. The most important thing from my perspective is that be aware of the differences in the remedial toolkit you have versus what others might have. I think we probably all saw the FTC's enforcement action against Voyager for its misrepresentations regarding FDIC insurance, for which they exercise the authority under the FTC Act. I would say that we should think about the various statutes that we have here. There obviously is the Truth in Savings Act and Regulation DD, which applies to banks, but also applies to one that would be considered a deposit broker. There is, under the Federal Deposit Insurance Act, rules that, that were transferred from the FTC to the CFPB about depository institutions that don't have deposit insurance and what they disclose. That's not really going to help us, I think, in this case, because it's a very different issue and it's almost a null set of what that covers. But most importantly, the prohibition, UDAP, unfair, deceptive, abusive acts and practices, I think you will see that may be a tool when it comes to material misrepresentations or omissions, where the standard of proof is quite different, and I think has a rich case law for which will be useful. So there will certainly be states, there will certainly be the CFPB who will want to work with you on that to the extent you feel that it's useful. I would say in addition, we want to think about remedy very strategically. In some cases, disgorgement beyond civil penalties may be appropriate. And I think we'll just need to continue to all think about where all those authorities are and how to effectively exercise them. I will just share my official statement. I'll try and go quickly for time, but today the FDIC is voting on a final rule to update the framework governing official FDIC signs and advertising requirements, as well as misrepresentations related to federal deposit insurance. This may seem like a random issue for the board to focus on, but it's not. There's now a murky convergence of non-banks, banks, and deposit-style products in the market. Non-banks are increasingly offering deposit-style products in partnership with insured banks. The non-banks often tout that consumer funds benefit from FDIC insurance on a pass-through basis to leverage the FDIC's reputation. But depositing funds with a non-bank is different than a deposit with an insured bank, even if funds are eligible for pass-through. Pass-through insurance coverage is not automatic, it's not guaranteed. Moreover, it does not protect the public from certain risks associated with the failure of the non-bank, including the potential for frozen funds. In addition to pass-through insurance arrangements with banks, non-banks may also offer standalone products that look like deposits. Venmo, Cash App, PayPal, others, for example, offer general balance products, and if the non-bank entity fails, consumers that have funds stored in these general balance products may lose their money. Addressing these issues will be challenging. And at a minimum, I think this step we're taking today of updating sign and advertising rules from 2006 is useful. This is new sign and disclosure requirements for digital banking, requirements for segregating deposit and non-deposit areas, disclosures that clarify non-deposit products offered by banks are not insured, are not deposits, and may lose value in certain circumstances. I think this is pretty sensible. Even with the rule and certain provisions that seek to clarify arrangements between banks and non-banks, there is still ongoing possibility of confusion. Digital dark patterns, all sorts of ways this is marketed. There will be new ways in which we have to think about how this could be exploited. I think given the limitations on the FDIC's authority, federal and state agencies will need to use their authorities to prevent unlawful practices, particularly in the marketing of these products. We at the CFPB are looking at these schemes and other products. Our 2022 guidance reminds market participants that they likely violate the Consumer Financial Protection Act's prohibition on deception if they misuse the name or logo of the FDIC or NCUA, or engage in false advertising or make misrepresentations to consumers about insurance. Last month, we proposed subjecting non-bank payment companies to the same supervisory exam process as large banks, where we can determine if these firms are stretching the truth on federal deposit insurance or otherwise implying they are banks. We have also issued a nationwide consumer advisory urging consumers to sweep funds stored on popular non-bank payment apps to their insured FDIC, their FDIC or NCUA insured account. At the end of the day, people recognize the FDIC's logo, the classic black and gold sign at teller windows, and the standard member FDIC disclaimer and ads. These symbols and phrases may seem quaint, but they invoke and embody the trust that our banking system is built on. I want to thank the chairman, the board. I know we had to make some changes. We all had to give on this one, and I hope we'll continue, though, to pursue an enforcement strategy and other initiatives that limit misrepresentations and the ability of bad actors to exploit the public's confidence in the FDIC. Thank you all.
Thank you very much, Director Chopra. And let me underscore the points you raised about the value of collaboration between the CFPB and the FDIC, particularly around the non-bank financial institution issues. So thank you. There are no other comments or questions from the board. May I have a motion with respect to the final rule on FDIC advertising, misrepresentation of insured status, and misuse of the FDIC's name or logo?
So moved.
Thank you. And a second?
Second.
Thank you very much. I'll now call the roll for the vote. I vote aye. Vice Chairman Hill?
Aye.
Director McKiernan? Aye. Director Sue?
Aye.
Director Chopra?
Aye.
The motion is adopted. That concludes the discussion agenda for today's meeting. If there's no new business, we'll now move into closed session, and I thank everyone for their participation and thank the staff for their excellent work.